People keep asking me, Charlie, how do I make $1 million? And I tell them, well, first get your first 100,000 without eating or sleeping until you do, because that first $100,000, my friends, is the hardest, most miserable, most character building money you'll ever make. But once you've got it, the money starts working harder than you do. And that's when compounding turns from math into magic. You see, everyone wants to talk about investing strategies, market timing, or the next big stock. But the truth is, the real challenge isn't finding the perfect investment. It's becoming the kind of person who can actually hold on to their money long enough for compounding to matter. The first $100,000 isn't a financial milestone. It's a psychological transformation. It's not about intelligence. It's about discipline. When you're building that first bit of capital, you're not just accumulating dollars. You're rewiring your brain. You're teaching yourself to delay gratification in a world that worships instant rewards. And that's hard. The system is built to make you consume, not to make you wealthy. Every advertisement, every shiny object, every new gadget is whispering, spend it. And there you are trying to save it. That's swimming upstream against human nature. People underestimate how emotional money is. When you don't have much of it, every dollar feels alive. It burns a hole in your pocket. You feel it tug at you. You rationalize every purchase. Oh, I deserve this, or it's only $20. But 20 becomes 200, and 200 becomes 2,000. That's how wealth leaks away. Not in big dramatic mistakes, but in small daily acts of undisciplined thinking. The mind always finds a clever excuse to indulge itself. So the first $100,000, what it really does is teach you how to say no. It's a crash course in restraint. You learn that you can't buy everything, that comfort now often costs freedom later. You learn that wealth isn't built on brilliance, it's built on habits. And those habits are often boring, repetitive, and unglamorous. There's nothing exciting about watching your savings grow by slow increments, or investing in broad market indexes, or living below your means while your peers flaunt their new cars and vacations. But that's where character is forged, in boredom, not excitement. People think the market tests your intelligence, but it really tests your temperament. Can you stay consistent when nothing seems to be happening? Can you resist the impulse to chase shiny things? That's the essence of building the first $100,000. It's a battle between your long-term intentions and your short-term impulses. And most people lose, not because they're stupid, but because they can't control themselves. As I've said before, the first rule of compounding is to never interrupt it unnecessarily. But to get to that rule, you first have to survive the years when compounding seems invisible. There's a peculiar moment in the early stages of saving where your progress feels painfully slow. You save diligently, you invest responsibly, and yet the numbers barely move. You look at your account and it feels like the universe is mocking you. That's the part where most people give up. They tell themselves it's not worth it, that the system is rigged, or that they'll start again when they earn more. But the truth is, it's not the math that's broken, it's the psychology. You're still in the stage of planting seeds. The harvest comes much later. What the first $100,000 really buys you is control over your own mind. Once you've accumulated it, you've already proven something powerful about yourself, that you can live below your means, delay gratification, and stick with a plan when there's no applause. And that self-mastery is worth more than the money itself, because the same mindset that earns your first $100,000 is the same one that will earn your first million. The numbers just get bigger. The habits stay the same. There's another lesson in this early struggle. You start to realize how little you actually need. When you train yourself to live modestly, every extra dollar becomes optional, not essential. That freedom of not being desperate for the next paycheck, not needing to impress anyone, not having to compromise your values just to maintain a lifestyle, that's real wealth. You can't build compounding financial returns without first building compounding self-control. And make no mistake, discipline compounds just like capital. The longer you practice restraint, the easier it becomes. The decisions that once felt painful become second nature. You start to enjoy simplicity. You find satisfaction not in consumption, but in accumulation of assets, of knowledge, of time. That's the mental shift the first $100,000 demands. You're not just saving money, you're constructing a new operating system for your mind. It's easy to quote Einstein calling compound interest the eighth wonder of the world, but what people forget is that compounding only works if you give it time. And time only works for you if you stop sabotaging yourself. So the first $100,000 isn't about outsmarting the market, it's about outsmarting your own impulses. Once you've done that, you've already solved 90% of the wealth building equation. The first $100,000 is hard because it's supposed to be. It's the test that separates wishful thinkers from serious builders. It's where you learn whether you can play the long game without losing patience. And once you pass that test, money stops being an emotional battlefield. It becomes a tool, obedient, compounding quietly in the background while you focus on living wisely. And here's the irony. Once you've earned your first $100,000 the hard way, you'll never want to spend it, because by then you'll finally understand what it took to build and what it can become if you just let it grow. Closing thought, a brewery. The first $100,000 is not a finish line. It's the initiation fee for entry into the world of compounding. Pay it once and you'll never look at money or yourself the same way again. If the first $100,000 is about discipline, the next stage is about patience. And patience in investing and in life is one of the rarest forms of intelligence. The world today worships speed, fast money, fast news, fast success. Everyone wants to double their income overnight, find the next Tesla, or chase whatever fad is trending on social media. But compounding doesn't care about trends. It moves at its own pace. And if you can't learn to wait, you'll never see its rewards. Most people think of compounding as some abstract math formula, something that happens on a calculator or a spreadsheet. But compounding isn't about math. It's about behavior. It's the quiet miracle that happens when you don't interrupt the process. It's less about brilliance and more about stubborn endurance. The person who simply sits still, invests regularly, and avoids doing stupid things will, over a long enough timeline, outperform the person chasing every clever idea in the market. Because compounding rewards the patient, not the brilliant. I've seen it time and again, people who are smarter than me, more educated, better informed. They can recite economic theory, quote valuation metrics, and dissect balance sheets in their sleep. But they can't sit still. They have to do something. They tinker, they trade, they speculate. They can't resist the itch to outsmart the market. And every time they act on that impulse, they reset the compounding clock back to zero. You don't get rich from making brilliant decisions. You get rich from making good decisions and letting time magnify them. You could say that compounding is a test of temperament disguised as a financial principle. It rewards the person who can look foolish in the short term for being right in the long term. And most people can't tolerate that. We're wired for feedback. When we plant something, we want to see it grow. When it doesn't move, we get restless. That's human nature. But the market doesn't bend to your emotions. It punishes them. The irony is that the longer you stay invested, the less brilliance you need. The math starts to do the heavy lifting. Imagine you plant a tree that grows just a little every year. For a while, it looks unimpressive, thin, fragile, maybe even disappointing. But over decades, it becomes massive, shading everything around it. That's what compounding does with money. The early years feel slow and insignificant, but the later years are exponential. The problem is that most people never make it to the later years. They quit in the early ones because they can't stand the boredom of slow growth. That's why compounding feels almost unnatural. It goes against every modern instinct. We live in a world where people expect instant results, where success is measured in likes, not years, but compounding only works in decades. It's old-fashioned. It demands humility, the willingness to accept that you don't control the pace of progress, and that humility is precisely why it works. While the impatient chase shortcuts, the patient quietly let time do its magic. One of the greatest misunderstandings in investing is thinking you need high returns to get rich. You don't. You need reasonable returns sustained for a ridiculously long time. A modest rate of return compounded over decades beats a flashy return interrupted by panic or greed. I'd rather earn 10% for 30 years than 50% for 1 year followed by a loss. The math proves it, but most people can't emotionally handle that truth. They want excitement, not endurance. And here's where compounding turns philosophical. Because what it teaches you about money is what it teaches you about life. Progress is invisible until it's undeniable. You'll spend years doing the right things, saving, investing, learning, and it will feel like nothing's happening. But beneath the surface, something is happening. Growth is accumulating silently, imperceptibly. Then one day it appears all at once and everyone calls you lucky. They don't see the years of quiet patience that built the luck. There's a paradox here. Compounding is simple, but it isn't easy. The hardest part is not doing more, it's doing less. It's resisting the urge to fiddle, to fix, to overthink. The investors who do best aren't the ones constantly predicting, they're the ones constantly waiting. Compounding doesn't need your genius, it just needs your cooperation. The funny thing is, the longer you let compounding run, the less it feels like work. Your money starts to earn more than you do. Each year's growth feeds the next and momentum takes over. It's a beautiful thing to watch, your future being built quietly by the decisions you made years ago. But you only get to that point if you trust the process long enough to let it happen. If you understand compounding deeply, it changes how you view everything. You stop rushing. You start valuing time over timing. You stop chasing novelty and start respecting consistency. You realize that wealth, real wealth, isn't the result of one brilliant move, but 1,000 small, unexciting ones compounded over a lifetime. And if you truly grasp that, you'll see that patience isn't passive. It's strategic. It's the most underrated form of strength in finance and in life. Because when you can wait, when you can persist while others quit, the world eventually hands you everything they abandoned. Closing thought.
Okay.
The secret isn't to outsmart the market. It's to outlast it. Compounding doesn't reward brilliance. It rewards those who are humble enough to let time work harder than they do. Now, once you understand patience and compounding, you come to realize that success in investing and in life isn't mostly about doing brilliant things. It's about avoiding stupid ones. Most people don't fail because they lack genius. They fail because they can't stop making unforced errors. In my experience, it's far easier to avoid stupidity than to chase brilliance. And the results are often better. You see, human beings have a natural tendency to overcomplicate everything. They want to believe there's a secret formula, a shortcut, some hidden knowledge that separates the rich from the rest. But the truth is boring. Wealth comes from consistency, not cleverness. It's not about predicting the next big trend. It's about not blowing yourself up while everyone else is busy guessing. The real danger isn't that people are too dumb to invest well. The danger is that they're too emotional. Fear, greed, envy, those are the true enemies of compounding. You can be a genius with a PhD in finance, but if you panic at the bottom or get greedy at the top, you'll still lose money. Intelligence without temperament is a liability. And what's more, most people overestimate their ability to control emotion under stress. They think they'll be calm when the market crashes. They won't be. The brain reverts to survival mode, and suddenly all the logic in the world evaporates. That's why I've always said the first rule of compounding is don't interrupt it unnecessarily. But I'd add a corollary, don't tempt fate. Don't put yourself in a position where emotion has the power to undo years of hard work. That means avoiding leverage you don't understand, speculation you can't afford, and fads you can't explain. It means saying no when everyone around you is saying yes. Hey, Breher, there's enormous wisdom in simplicity. People underestimate how powerful it is to just stay within your circle of competence, what you truly understand. When you start reaching beyond it, you're playing someone else's game, and that's how you get hurt. The world is full of people trying to look smart, but very few trying to stay solvent. And that's another truth most don't appreciate. In investing, survival is underrated. You don't have to be extraordinary. You just have to avoid destruction long enough for compounding to work. The goal isn't perfection, it's endurance. If you can just stay in the game, time will do more for you than talent ever could. I've spent a lifetime watching investors self-destruct, and I can tell you, it's rarely bad luck. It's usually bad behavior. They trade too much. They follow the crowd. They borrow too heavily. They chase things they don't understand. The pattern never changes because human nature doesn't change. As I've often said, it's remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent. Avoiding stupidity means knowing your weaknesses. It means acknowledging that you are susceptible to bias and emotion. Most people don't want to face that. They think admitting weakness makes them vulnerable. But in truth, it's the foundation of rational behavior. Once you accept that you're fallible, you start designing systems to protect yourself from yourself. You automate savings, you diversify, you avoid short-term noise. You build structures that make good behavior easier and bad behavior harder. There's also a moral dimension to all this. The pursuit of brilliance often feeds ego. The avoidance of stupidity cultivates humility. When you focus on not being foolish, you learn to respect risk. You recognize that luck plays a role in every success story, including your own, and that arrogance is often the prelude to disaster. I've seen people make a fortune and lose it twice because they thought the rules no longer applied to them. They start believing their own press releases. And the market has a way of teaching humility to those who forget it. If you can master the art of doing less, of avoiding avoidable errors, you'll find that compounding takes care of the rest. The irony is that the less you try to be a genius, the better your results often become. Simplicity, patience, restraint. These are not glamorous virtues, but they are powerful ones. They protect your downside and quietly let the upside accumulate. I like to think of it this way. You don't need to be brilliant to become wealthy, but you do need to avoid being stupid long enough to let intelligence work. Every time you resist the temptation to speculate, every time you ignore the crowd's hysteria, every time you choose discipline over impulse, you extend the runway for compounding to do its job. And that's really the key. Compounding is fragile. It needs protection. One bad decision, one emotional mistake can undo years of progress. So instead of asking, what's the next big thing I should do? Try asking, what dumb thing am I tempted to do and how do I avoid it? You'll find that question pays better dividends than almost any piece of financial advice you'll ever hear. Closing thought, Eberker. In the long game of wealth, survival is victory. You don't need to be a genius. You just need to avoid being stupid long enough for time to reward your patience. If the first $100,000 teaches discipline and compounding teaches patience, then the next great lesson is learning to live below your means, not just for a few years, but for life. Because the truth is, the ability to build and keep wealth has far less to do with how much you earn and far more to do with how much you need. Most people never get rich because they spend like they're already rich. They confuse appearance with achievement. They chase a lifestyle that consumes every dollar they make, and then some. And the problem with that game is simple. It has no finish line. You can't out-earn your desires. No matter how much money you make, the appetite for more always grows faster. That's why learning to live below your means is not a temporary phase. It's a permanent discipline. Now, I'm not talking about being cheap. I'm talking about being rational. There's a difference. Cheapness is an obsession with price. Rationality is an understanding of value. When you live below your means, you're not depriving yourself, you're buying freedom. You're buying control over your time, your decisions, and your peace of mind. You're trading short-term indulgence for long-term independence. When you spend every dollar you earn, you're effectively selling your future to finance your present. And that's a bad trade. The goal is to reach a point where your money works harder than you do. But that only happens if you give it the breathing room to grow. Every unnecessary expense is a small act of sabotage against your own compounding engine. The people who understand this principle aren't necessarily the highest earners. In fact, many high earners are broke. They just do it in style. They live in bigger houses, drive newer cars, take fancier vacations, and convince themselves they deserve it all because they work hard. But the market doesn't care how hard you work. It only rewards how well you allocate. And if you allocate your money toward consumption instead of investment, you're simply feeding a cycle that ends in dependency. Living below your means is a quiet rebellion against a world built on consumption. Every billboard, every ad, every influencer is designed to make you feel like you're missing something. And the moment you start believing that, you've lost. Because the richest person isn't the one with the most possessions. It's the one who needs the least. Once your wants shrink below your means, you're free, truly free. It's also remarkable how psychological this is. Lifestyle inflation, the gradual increase of spending as income rises, isn't about logic, it's about ego. People don't upgrade because they need to, they upgrade because they can. They use consumption as a scoreboard, a way to signal success to the world. But the scoreboard lies. The man driving the fancy car often works for the bank that actually owns it. There's deep wisdom in what might seem like old-fashioned frugality, because restraint compounds just like capital. Every dollar you don't spend unnecessarily becomes a worker in your future army of wealth. And once you understand that, you start viewing money differently. You stop seeing it as something to burn and start seeing it as something to deploy. Now, there's a philosophical layer to all this too. The ability to live below your means is a test of self-awareness. It asks, what is enough for you? Most people never answer that question honestly. They chase more without ever defining it. But a life built on endless more is a treadmill. You run faster, but you never get anywhere. The paradox of wealth is that the faster you chase it, the more it escapes you. Real wealth grows quietly in the space between desire and discipline. When you master that space, everything changes. You stop competing with others and start compounding for yourself. You start valuing peace over prestige, security over status. And the funny thing is, once you stop trying to look rich, you eventually become rich because your capital stops flowing outward and starts accumulating inward, slowly at first, then powerfully, then inevitably. And this idea goes beyond money. It's about philosophy. It's about rejecting the illusion that happiness comes from excess. The happiest people I've met weren't the ones with the biggest houses or the flashiest cars. They were the ones who had options. They controlled their time. They made decisions based on principle instead of paycheck. And they slept soundly because they weren't chained to debt or appearances. Living below your means isn't ascetic. It's liberating. It's the art of saying, I already have enough. And that's an art very few people ever learn, because the world keeps whispering just a little more. But if you can silence that voice, if you can build a life where your happiness isn't leveraged to your income, then compounding becomes unstoppable. The person who saves consistently and invests patiently will eventually surpass the spender who looks rich today. It's just arithmetic, but it's also character. The restraint you show now doesn't just grow your bank account, it builds your mind. It strengthens your ability to wait, to think, to choose deliberately instead of impulsively. And over time, that self-control compounds into a kind of wealth that money alone can't buy, because it's not just financial security, it's psychological freedom. It's the peace that comes from knowing you could buy something, but you don't need to. Closing thought. Hey, bro, living below your means isn't about limitation. It's about liberation. The less you need, the more power you have. And in the long run, that power, quiet, disciplined, and compounding, is what turns modest earners into millionaires and restless spenders into stories of regret. By the time you've learned discipline, patience, and restraint, the real magic begins. The point where the snowball starts to roll. That's the beauty of compounding. It rewards consistency far more than intensity. You don't have to push the snowball forever. You just have to get it moving in the right direction, and gravity does the rest. Most people never make it to that point because they give up too early. They plant the seed, water it for a season, and then dig it up to check if it's growing. Compounding doesn't work like that. It's quiet, invisible, and maddeningly slow until it isn't. In the early years, it feels like nothing's happening. Your account balance inches upward, barely noticeable. You question whether it's even worth the effort. But if you stay the course, something extraordinary happens. Growth starts feeding on itself. Each gain creates more gains, and suddenly the curve tilts upward. What once felt glacial begins to accelerate, and that's the moment you realize the snowball has taken on a life of its own. This is where the psychological battle shifts. In the beginning, the challenge is saving and delaying gratification. Later, the challenge is doing nothing. Once your investments are working, your biggest job is to leave them alone. You stop being the worker and start being the overseer. The money is now doing the labor. You just have to keep from interfering. But that's not easy for most people. The human mind craves control and activity. It wants to improve things, to take action, to feel useful. But in investing, constant action is poison. The great paradox is that wealth often grows fastest when you stop trying so hard to grow it. Patience is what separates the compounding few from the impulsive many. Think about a snowball rolling down a hill. It starts small, awkward, slow, but as it rolls, it accumulates mass. And with that mass comes momentum. The larger it grows, the faster it moves. The same principle applies to wealth. The first dollars you save are painfully earned, but once you've accumulated a meaningful base, the growth starts compounding faster than you can add to it. Eventually, your capital earns more in a year than you could earn from working. That's the point where the dynamic flips from you working for money to money working for you. And that's the real turning point in a person's financial life. Not the first big paycheck or the first investment win, but the moment when effort gives way to momentum. It's not about being lucky or brilliant. It's about staying alive and staying consistent long enough for the snowball to roll on its own. That's why I often say the first rule of compounding is to never interrupt it unnecessarily. Because once you stop the motion, once you liquidate in fear or chase some fad, you're back at the top of the hill, pushing from scratch again. There's also something deeply philosophical about watching compounding work. It teaches humility. You start to realize how small daily actions, saving a bit, reinvesting dividends, ignoring short-term noise, add up over years to something vast. You begin to appreciate time as your greatest partner. And with that appreciation comes a kind of calm. You stop obsessing over the next quarter and start thinking in decades. You become less reactive, less anxious, more deliberate. The very process that builds your wealth also refines your mind. The trouble is, most people never give compounding enough time to reveal its power. They get bored. They get impatient. They want to optimize. They sell too soon or switch strategies right before the payoff. It's a bit like bailing on a marathon at mile 20 because you're tired. You were close, but you couldn't stand the discomfort of waiting. Compounding doesn't reward the clever. It rewards the disciplined. It demands that you surrender the illusion of control and trust the mathematics of time. And there's another lesson here. The longer your snowball rolls, the less it depends on you. That's both a comfort and a warning. A comfort because it means the system is working without your constant effort. A warning because it means one bad decision, one rash interruption can destroy what took decades to build. Compounding rewards care but punishes impulsiveness. There's a point, too, where compounding becomes not just a financial process, but a mindset for life. The same principle applies to relationships, knowledge, habits. Everything that grows meaningfully does so through accumulation over time. Small improvements, patiently sustained, turn into profound transformations. That's why compounding is as much a philosophy as it is a financial law. It's a way of thinking about progress itself. Once your snowball is rolling, the only remaining task is to protect it. Don't take on risks that could wipe it out. Don't chase returns that promise more than patience already provides. Let it roll and focus instead on the one variable you truly control, your behavior. Because in the end, compounding isn't about what you know. It's about what you can resist. There's a certain quiet joy in watching your snowball gather speed, not because of the money itself, but because of what it represents. A long series of wise decisions, small sacrifices, and consistent patience that the world never applauded, but time eventually rewarded. It's proof that the slow path, though unglamorous, is the most reliable one. Closing thought, Abe Brewery, the Snowball, doesn't need brilliance to roll. It needs consistency, direction, and time. Once it's in motion, your only job is not to step in its way. By now, you've seen how money compounds, how discipline, patience, restraint, and time work together to create something almost magical. But there's another kind of compounding, one that's even more powerful and far less volatile, the compounding of knowledge. Money compounds externally, wisdom compounds internally, and the latter feeds the former. Because the more you understand the world and yourself, the better your decisions become. You don't get smarter all at once. It happens gradually, quietly, through years of curiosity and humility. Every book you read, every mistake you reflect on, every conversation with someone wiser than you adds a small layer to your understanding. Over time, those layers build upon each other until your judgment, your ability to see reality clearly, becomes your greatest asset. The world may change, markets may rise and fall, but sound judgment endures. Most people stop learning once they leave school, which is precisely why they stay average. They think education ends with a diploma, but real education begins when you start questioning your own assumptions. Knowledge, like wealth, rewards the compounding mind, the one that keeps adding, keeps questioning, keeps refining. You have to keep your curiosity alive long after the incentives disappear. The best investors I've ever known are not gamblers or speculators. They're learning machines. They read constantly, not just about finance, but about history, psychology, biology, physics, because they understand that the world is interconnected. The more mental models you collect, the better you can interpret what you see. When you learn across disciplines, you begin to recognize patterns that others miss. You stop reacting to headlines and start understanding cause and effect. And that understanding is what allows you to stay calm when everyone else is panicking. Learning also compounds in another way. It reduces your susceptibility to stupidity. The more you know about how humans behave, the more you can anticipate your own blind spots. You learn about confirmation bias, about overconfidence, about how emotions hijack reason. And once you recognize those traps, you can design habits and systems to protect yourself from them. Knowledge becomes armor. It doesn't eliminate mistakes, but it helps you make smaller, more survivable ones. There's a humility that comes with continuous learning. The more you know, the more you realize how little you actually understand. That humility is a superpower in investing. It keeps you cautious when others are euphoric and curious when others are complacent. People who think they already know everything stop paying attention. And when you stop paying attention, the world quietly changes around you. Continuous learners don't assume, they observe, they adapt. And because they adapt, they survive. One of the greatest delusions is thinking knowledge is static, that once you've figured it out, you can relax. But the world doesn't freeze for your convenience. Technology evolves, incentives shift, entire industries rise and fall. The only way to stay relevant, financially or intellectually, is to keep learning faster than the world forgets. That's why the best minds don't cling to certainty. They hold their beliefs lightly, ready to update them when new evidence arrives. And let's not overlook this. Learning doesn't just improve your returns, it improves your character. It cultivates patience, skepticism, and curiosity, the exact traits that make you both a better investor and a better human being. It teaches you to respect complexity and to avoid arrogance, because if compounding money requires time and consistency, compounding wisdom requires humility and reflection. There's also a psychological dividend to learning. It gives your life direction beyond the pursuit of wealth. Money can buy comfort, but knowledge gives meaning. It keeps your mind active, your perspective broad, your ego in check, It allows you to connect dots between seemingly unrelated ideas, to see opportunities where others see confusion. And that skill, the ability to synthesize, to understand, is the ultimate competitive advantage. Over time, as your knowledge compounds, something subtle happens. You stop chasing certainty and start seeking clarity. You realize that wisdom isn't about having all the answers. It's about knowing which questions matter most. You stop trying to predict the future and instead learn to prepare for it. That mindset shift from prediction to preparation is the hallmark of long-term thinkers. When I look back on a lifetime of investing, I can tell you that the greatest returns didn't just come from the money I put in the market. They came from the time I put into learning how the world works and how to keep my own mind from working against me. Knowledge compounds invisibly at first, then all at once in the form of better judgment and fewer mistakes. It's the silent partner to every fortune that lasts. So if you take one idea from all of this, from the first $100,000 to the million that follows, let it be this: never stop learning. Make curiosity a lifelong habit. Read constantly. Reflect regularly. Think independently. Because while your money compounds in your account, your mind compounds inside your skull. And the latter, if properly cultivated, will never lose value. Closing thought, Abe Brewer. The most powerful form of compounding isn't financial, it's intellectual. Money can make you rich, but knowledge makes you wise. And in the long run, wisdom always outperforms wealth. So make your first $100,000. Guard it, grow it. Let compounding do its quiet miracle. It's not about getting rich quick. It's about getting rich sure. And as I've said before, the big money is not in the buying or the selling, but in the waiting.